traded funds versus mutual funds is an ongoing debate. We've had a number of ETF manufacturers on this program. Today we have Larry Berman of Berman's Call and the Chief Investment Officer for ETF Capital Management to talk about his perspective. Welcome, Larry, and thanks for coming.
Oh, my pleasure.
Now, a couple of weeks ago, Barclays had a study talking about the fact that a lot of high net worth investors would like to be in ETFs, but in fact, very few of the advisors were recommending them. I suggested on my blog that the reason was advisor compensation and that ETFs are more appropriate in a fee-based environment. What's your take on that, Larry?
Well, that's obviously one of the main reasons why. The way the industry is set up, it trains advisors to go out and collect assets and not necessarily manage those assets. It's kind of interesting. So advisors will typically have the relationship with the client, but someone else usually is running the money on these platforms. So think about it this way: in a transaction-based model for advisors. Let's say they have 300 clients. They've got to call up all those 300 clients to say, today I want to buy some XIU for you so you can have some TSX 60 exposure, and we want to sell some XSP or our S&P 500 exposure. Make that transaction. Well, those 300 calls might take 2 weeks to make. So it doesn't really suit the way most advisors in the industry are structured to run their business.
So you prefer, I guess, a buy and hold approach for some clients and sort of asset class investing. Now, I know you add a lot of value, and we're talking the second segment about how to speculate and do hedging strategies. But for that buy and hold audience, can you describe how ETFs fit in that classic what I call asset class investing paradigm?
Yeah, well, ETFs are an elegant portfolio solution, really. It allows you to get exposure these days, any asset class in the world, primarily through exchange-traded products, whether they're ETFs or ETNs. And so you don't have to be an expert in India, for example, and know which stocks to pick. You just buy the exposure to that market. So it's elegant in that way. And if India is not doing well, maybe it's China, maybe it's other parts of emerging markets, you can go and pick and build your portfolios at a relatively low cost. Now, that's fine for buy and hold, and you can accept the returns of the market. But really, the markets are very volatile. And so in a case like 2008, where we saw a peak to trough decline of 50%, so let's say for the average mutual fund, if you were doing the same thing with ETFs and just buy and hold, so your return was down 48%. So you're a little bit better off because at the core of that asset allocation decision is, are you in the market or aren't you?
I think in our preliminary interview you talked about a no-brainer transaction being if you're in bank no-load funds and what you should be doing.
Actually, for sure, right? So if you're in a mutual fund that really just tracks the index, you want to be in the cheapest possible way to get that index exposure. So in the U.S. markets, Vanguard, for I think it's about 7 or 7.5 basis points, gives you exposure to the S&P 500. Most managers who are trying to beat the S&P 500 don't anyways. So why not just buy the index, get that exposure for as cheap as possible, if you're going to be a buy and holder.
Yeah, I think Vanguard has the total market approach too, which is beyond the S&P 500, both in the to the total U.S. market plus the global equivalent. Talking about the banks, BMO, Bank of Montreal, is both a bank no-load player plus the BMO ETFs. And you were talking about India-China funds. I was thinking that they have them hedged back into the Canadian loonie. Do you think that is that sort of schizophrenia there? They're going to end up cannibalizing their own mutual funds?
I think actually BMO is really smart. There's not a lot of room for all the banks to have ETFs. They've recognized the flow of funds in the U.S. markets and European markets are coming out of mutual funds and going into ETFs. That's what the end user, that's what the marketplace is demanding. So it's happening with or without them. The mutual fund companies that don't recognize this are going to, slowly lose assets, I believe. So I think BMO's at the front end of the curve. Yes, their no-load fund, may lose assets over time. They're going to lose them anyways. But the ETF side is actually growing in leaps and bounds, and at least that, there are big players there. So I think BMO is actually doing some good things there.
And last question for this segment, speaking of BMO, Then they also, through BMO Guardian, announced their equivalent to the Trimark Power Shares funds, which are essentially, as you know, ETFs wrapped in a mutual fund prospectus, paying their advisors a 1% trailer fee. What do you think of the BMO Guardian funds?
Listen, I'm a chief investment officer, I'm a portfolio manager, but we believe in active investing. For the most part, those type of investments are generally passive. They will give you a 60-40, weighting in stocks and bonds or something like that. And once a year, they'll rebalance back to an index. That's not active investing. Active investing is protecting your capital, preserving your capital in a bad market environment. And that might mean from time to time going to a big cash position. So those products are fine. It'll allow some advisors who have clients who want ETFs, but really it's no better than just picking a basket. It's a little bit better, than picking a basket of stocks and doing the same thing.
Great. Well, we're going into more detail in our second segment about hedging and some speculative sort of strategies one can do with ETFs. Thank you very much, Larry Berman of ETF Capital Management and the host of BNN's Market Call.